In the world of trading, you hear the word strength thrown around all the time, right? But what does it actually mean? Well, there are two terms that sound almost identical, and it's a classic rookie mistake to mix them up: relative strength and the relative strength index. So let's dive in and get this cleared up once and for all.
So which is which? One of them tells you if a stock is like a sprinter who's getting out of breath, and the other one tells you if it's actually winning the race against everybody else. And trust me, knowing the difference is an absolute game changer when it comes to spotting the true market leaders.
And really, this slide sums it all up in a nutshell. On one hand, you have the Relative Strength Index, or RSI, which is all about a stock versus itself. It's like an internal health check. On the other hand, you have Relative Strength, or RS, and that's all about a stock versus the market. It's an external competition. Let's break down the RSI first.
All right, so first up, we're looking inward. Think of the RSI as a kind of momentum gauge. It's telling you how strong a stock's own recent price action has been. It's all about its personal history, its own performance.
So, what is it exactly? Well, it was developed by the legendary J. Wells Wilder, and the concept is actually pretty simple. The RSI just measures the size of a stock's recent gains against its recent losses. It's a totally closed system, scoring the stock on a scale from 0 to 100 based only on its own price movements.
Now, there are two magic numbers you gotta know with RSI. The first one is 70. When the RSI gets up above this level, we call that overbought. It basically means the stock has had a fantastic run and, well, it might be getting a little tired and could be due for a rest or a pullback.
And on the flip side, of course, you've got the number 30. If the RSI reading drops below this level, that suggests the stock is oversold. The selling has been pretty intense, and it might just be poised for a bounce. It's a sign that all that negative momentum could be running out of steam.
But here's the thing. Most pros rarely use the RSI all by itself. A really popular strategy is to combine it with another indicator, like the MACD. That stands for Moving Average Convergence Divergence. It just helps track the trend. For a really solid buy signal, you'd want to see the RSI cross above that halfway mark of 50, while the MACD lines are also rising. That way, you're confirming that both the short-term momentum and the bigger trend are on your side.
Okay, time to shift gears. We're moving on to our second concept, relative strength. We're done looking in the mirror, now it's time to check out the competition. You see, relative strength, or RS, isn't about how a stock feels about its own performance, it's about how it's doing against everyone else on the track.
So the key takeaway here is that relative strength is just a direct comparison. It answers one simple question. Is this stock going up more or maybe dropping less than the rest of the market? If the answer is yes, then it's showing true leadership.
And this whole idea gets boiled down into one super powerful number, the RS rating. It scores a stock from 1 to 99. So a rating of, say, 90? That's a fantastic sign. It literally means that stock has outperformed 90% of all other stocks over the last year. The real market leaders? They often have RS ratings of 80 or higher.
And you can actually spot these leaders just by looking for some subtle clues. The most obvious one? A stock that finishes in the green on a day when the whole market is red. Or maybe the market makes a new low, but your stock just refuses to. It holds its ground. You might also see these huge spikes in volume on up days, or notice that the stock is always closing near its high for the day while the market kind of limps into the close. These are all telltale signs of institutional support. That's big money quietly buying up shares.
And that's why this matters so much. See, relative strength helps you zero in on the stocks that have that serious underlying demand before they make their big explosive breakout moves. It's all about finding what the institutions are accumulating.
One of the absolute best tools for this is something called the RS line, which simply charts a stock's performance against the S&P 500. And here's the real kicker, the key insight on this slide. The RS line is often a leading indicator. It can actually start rising even while the stock's price is just chopping sideways, telling you that the smart money is building a position under the surface.
Now, this isn't just some neat charting trick. This is a legitimate strategy backed by decades of data and used by professionals. So let's take a look at the proof and then see how the pros manage the risks that come with it.
Okay, don't let this table intimidate you. It comes from a research paper by Cambria Investment Management, and what it shows is incredible. It proves that a pretty simple strategy, just investing in top-performing sectors based on their relative strength, has historically crushed a basic buy and hold approach. Just look at the long-term compound annual growth rate. It's just consistently higher for the relative strength portfolios. And this isn't some recent fluke. We're talking about data going all the way back to the 1920s.
But of course, there's a catch. The biggest weakness of a pure relative strength system is right here. It's always fully invested. And that means when the entire market decides to crash, even the strongest stocks are probably going down with it, leaving you totally exposed to some major losses.
So what's the pro move? They add a simple timing filter. You still invest in the top-ranked stocks or sectors showing the best relative strength, but, and this is the important part, you add one rule. If the broader market, like the S&P 500, falls below a long-term trend line like its 10-month moving average, which is just the average closing price over the last 10 months, you sell everything and move to cash. It's a simple hedge that protects your capital during those nasty bear markets. So if you take away just one thing from all this, let it be this idea right here. The RSI, it tells you if your stock is getting tired, if it's getting overextended. But the RS, that tells you if it's actually winning the race. Both are useful, for sure, but they are telling you two very, very different stories.
And that really brings us to the final question for you. Now that you know the difference, which form of strength is going to be more important in your analysis? Are you going to focus on that internal momentum, the external competition, or maybe a combination of both? That clarity right there is your new edge.